Welcome to what we're calling the Miles Better Finance Friday series of videos about all things from the Accounting Translator Guide. My name is Colin Miles and I am the CEO of Miles Better. Thank you for joining us as we look to bring to life in plain speak the various definitions from the Accounting Translator Guide. Today we're going to be looking at profit, one of the most important terms that we need to translate. So what is the definition of profit? Well, many people will tell you it's sales less costs. So let's use this pen as an example. I buy this pen in June for $10 and I sell the same pen in July for $20. So on paper, it looks like we've made a profit of $10. But here comes the loaded question. When did I make the profit? In the above example, if we use sales less costs, in June, we had no sales, but we had costs. We lost money because we bought something. Money left our business. In July, we sold the pen. We liked that, and we received $20 inflow. We like that even better. And it looks like we've made, on paper, $20 profit, as lots of sales and no costs. So, let's not buy any pens, I hear you say. We'll only sell them. So much more fun. Well, what we actually have just looked at is cash flow, because we can check out some of the other videos to further understand. It's the movement of cash that we have just talked about. So now let's revisit that above example with the correct definition of profit, which is sales in a period less the costs in that period to actually produce those sales. So in the profit example above, the profit occurs in July when we sell the pen. Because in June we make no profit and we make no loss as we've swapped cash for an asset. Oh, so many fun terms to watch in some of the other videos. The magic happens in July when we sell the pen for $20. That draws a line in the sand of July. And then we allocate the costs of the sale. Doesn't matter when we bought the pen, doesn't matter how we have the pen, but the cost of the pen is $10. So yes, the profit is 10 because it's $20 less $10, but the event took place in July. That's the key point. That's why businesses don't report a profit or loss when they're in the build-out phase, as no sales and therefore no profit and loss. But they'll bring those costs in to match the sales over a period of time. Do check back for some more of the videos when we explore some of those particular accounting translated terms. Hence, the most important number actually on the profit and loss is the date. We need to know what period we're reviewing so that we understand when the action, the magic, actually happened. I hope that now makes a little more sense as to what the real definition of profit is. Thank you for joining us as we look to bring to life in plain speak the various definitions from the Accounting Translator Guide. Today we're looking at the term balance sheet, one of the three key documents that we need to understand in business. Some people think it's called a balance sheet because, as in many cases in accounting, there are two sides and they have to balance. Well, in this case, that's not actually the case. It is literally a list of balances of the wealth statement of your company. What do I mean by that? Well, as I say, it lists everything that you own. So included in that would be fixed assets and current assets. Two more terms that we'll explore in other videos. But for today, a fixed asset is a building and a current asset is something that you can sell or you can liquidate. So cash or perhaps an IOU where you've sold something. So we list everything down that you own. That's your positive side of the equation. Then, unfortunately, we have to list everything that you owe. And that also has a funky name called liabilities. So we'll have long-term liabilities and short-term liabilities. Long-term usually are debt. If you've gone and borrowed money from a bank or you've got an investor who doesn't want his money back today, but is still somebody that you owe. The more current liabilities will be things like taxes to the IRS or HMRC in the UK. Maybe you have a staff that you owe, and obviously bills that you have bought that you haven't yet used, or you haven't yet paid. Now on the flip side, if that was stock, then that actually would be viewed as a current asset because you own the stock. So again, you can see there's a balancing number. So we first of all list everything that we own, and then we list everything that we owe, and then we subtract them. And then we hope, in most cases, that's going to be a positive number. And that's when it then becomes the wealth of the company. If you're a single shareholder of your own company, that number is very important to you because it's the wealth that you could have out of your business. But it's a line in the sand, and it's a number, as you can see, that is made up of things that we own and things that we owe. So at a very quick look, you can say, where is my cash? Well, your cash is tied up not only in the cash, but it'll be tied up in your business, the fixed assets, and also what the stock. We'll talk about that in another video as to the importance of stock and cash. But for today, the balance sheet is your wealth statement. It is literally everything that you own minus everything that you owe. And if it's in positive, your company has wealth. If it is negative, well, then your company is potentially in trouble. And we'll look at that in another format in another video. I hope that has brought to life and in some plain speak some of the understanding of what a balance sheet is. Well, today we're going to be looking at cash flow. This, as the name states, is the movement of the cash in your business. My favourite quote comes to play here. Sales are vanity, profits are sanity, but cash is king. Without cash, the engine oil of your business, the machine's going to seize up. That's why the balance sheet that we looked at in another video works hand in hand with the cash flow statement, as it tells you where your cash is locked up. This statement of cash flow in simple terms is cash at the beginning of the month on the 1st. We have cash coming into the business and we record those movements. We have cash going out and we record those, and we'll have a closing balance. Very straightforward, cash flowing in and cash flowing out. So using that inflow and outflow, if you're paying out more cash each month than you're receiving in, then you've got issues. And the investors in your business are going to be concerned. I can look at a cash flow statement very quickly and can instantly understand how good you are as a manager, owner, entrepreneur at the strategy of managing your cash. If we return to the example from earlier in the video of the pen, we can simply understand this concept a little more. All right, so remember, we bought and paid for the pen in June. So the key word here is paid. Cash left our business, but we sold the pen in July and got paid in July. And so we had cash coming into the business. Now, the challenge we have is that the cash left the business in 1 month, but didn't arrive into the business until the 2nd month. So what would happen in that case would be we'd need to have some bank facility or some initial investment. Otherwise, we've got no cash to pay for our bills. It doesn't matter that we made 50% profit on the sale. If we can't pay the bill, then the business is going to go under. This is the root cause of many fashion retailers going bust. You hear of high-profile businesses declaring they've got no cash. In the fashion world, if you buy stock, which is piles of cash, as we've talked about before, and it doesn't sell, you're in trouble. Your suppliers want paying, your rent wants paying, your staff want paying. Where's your money? It's in piles of cash on your shop floor, in your warehouse. In simple terms, a cash flow is the movement of money into your business and out of your business. And as with an engine, if you don't have any oil, it's going to seize up. I hope this makes some sense and brings to life in simple terms the word cash flow. Do check